Hi guys, welcome back to another video. After watching the first breakfast indicator video, many of you have requested for Forex breakfast indicator for cryptos, for commodities. Some of you even asked for the US futures. So in this video, I'm going to share more details about it. My breakfast indicator, one of the research methods which I'm using to track all these instruments. Now, this is a little different from the Indian breakfast indicator for the Indian markets. So pay attention. This is going to be a little different. I'll be honest with you, these markets are filled with highly trained, experienced traders. They're like sharks. They're waiting for you. The traders just like you, they're waiting for you and they're waiting to eat you up. All these big players, right? I'm telling you, I'll be very honest with you, all these big players, they have multi-million dollar algos. They are from all around the world. They're watching the same charts as you are watching, right? So the system which you're going to use has to be sophisticated enough to withstand all this pressure, yet it has to be simple enough for you to practice it every day, right? If you really want to survive in the markets, you have to build a system like this. If you remember from the last breakfast indicator video, I told you in a mock strategy that there are three parts: market structure, edge, and rules. So I'm going to discuss my core philosophy here about market structure, and then the breakfast indicator itself is the edge for us, right? Rules I'll leave up to you. I'll leave it up to you. It's up to you how you can figure that out, and you can complete your own breakfast strategy, or you can mix it up using a different indicators. It's up to you, right? I'm going to discuss the core philosophy and I'm going to tell you what is the breakfast indicator. So buckle up. This video is going to be a little long one and we have to put our focus in learning everything which I'm going to tell you. All right. So first, most critical, important information is if you see this chart, before you get into the charts, we have to change something. We have to change the time zone we are in. See the bottom of the chart, right? Here you can see that there is UTC -4. That is nothing but New York Standard Time, right? Eastern Standard Time as per New York. So wherever you are in the world does not matter. You have to change it. For example, you're in India. Let's say, for example, you're in India and your local time is UTC plus 5:30, right? 5 hours, 30 minutes. That's your time zone. You have to change it to New York -4. So New York -4 during daylight savings, and during your the other time zone, it'll be -5. So change it to New York. All right. Always change it to New York, and this is what we'll be using. The time frame we'll be using is 1 minute chart, micro scalping, and the time zone we have for the breakfast is very simple. It's between your 9:45 a.m. to 10:15 a.m. every day, right? This is New York Standard Time -4, UTC -4, or whatever it might can be -5 when there's a different daylight saving shifts. All right. So we are using New York Standard Time, that is your Eastern Standard Time. So in India or any part of the world, it might be different. So for India, it might be around 6:30, or sorry, 7:45 or 6:45 to 7:15 or 7 to 7:30, something like that. Okay. Pay attention. This is very important. You have to focus on this. You have to use it as per your time zone. And in your time zone, wherever you are in the world, change it to -4 UTC, New York Standard Time, or your Eastern Standard Time, right? Whatever you want to call it. And from there on, we will move on. This is the first critical information. Time frame, again, let me remind you, is your 1 minute chart. Now, before we proceed further, it is very important that you take a look at all the indicators first. Check if your favorite tool or your research chart which you're using for studying the markets is there. The first pack, you will have your US futures, which is your pack one. The E-mini futures, as well as your Russell is also involved in micro E-mini also. That is for your pack one. Pack two covers your commodities, mostly your COMEX futures, your gold, silver, crude oil, natural gas, your MCX futures, those who track MCX, gold, silver, crude, natural gas, the same, and also you'll have US oil and UK oil. This is your pack two. Now, pack 3 is your cryptos and Forex CFDs, XAU USD, your silver XAG USD, right? All that is there. Cryptos, your swap cryptos, spot cryptos, index cryptos, perpetual swaps, all that will come in your pack 3. So take a look at this and take a look at the list of all the items here. Make sure that it's there in this list what you're tracking, and then you move on to the next section. The introduction to the core philosophy of market structure is very simple. It's not complicated. Just pay simple attention. You will need it. Before a trending move in the market, there will be a correction or a retracement. This is nothing but your trend continuation. All right. Now, before a trending move, there will be weakness in the previous trend. This is nothing but your trend reversal. All right. So we are using these philosophies, these ideas, this ideology, applying Elliott wave patterns as we head into the breakfast time, right? So what you're doing is you're identifying the structure before the breakfast time. As simple as that. I've already said this before. Hands down, the best method is Elliott wave. I have provided an Excel resource for you. With my own experience, I have modified some calculations of calculating wave patterns. I've shared it in the Elliott wave master course. You have to study it. There is no, let's say, you can't ignore it right now. You cannot say I'll learn later, because you are dealing with highly sophisticated markets. We will need a method to identify patterns for the next probable path. All right. So I've shared this on YouTube. It's available in 4 different languages: English, Hindi, Tamil, and Telugu. Have a look at it, and then we will move on to the next part. Now, using this knowledge of market structure, we're going to identify setups using our edge. The first method is going to include SMC, or you can call it SMC concepts or ICT concepts, whatever you wish. We're going to use fair value gaps. Fair value gaps with my special tool, my special research, that is price macros. Second method will include pressure signals with GAN levels. Now, the second method is quite familiar with many of you who have seen the first breakfast indicator video, right, for the Indian markets. We have pressure signals. Pressure signals are long pressures and short pressure signals. They are a combination of price, time, and volume. And then we have GAN levels which get triggered with them, right? This is the second method. With this, we will combine your philosophy, your market structure, and your special levels price macros. Now, the last method, third one, is a combination of both first method and second method. This is the silver bullet, right? You must have heard this so many times, silver bullet, the name. But again, this is my method of silver bullet. I will be sharing it when we go down further in the lecture. Now, the first method, we're going to use FVGs, your fair value gaps, plus your price macros. What are price macros? Again, I won't be discussing that here. This is my personal research, and this is what has been saving me from many dreadful traps in the market. Fair value gaps. Now, fair value gaps is a fairly known concept to the public, but again, I have told this many times that 90% of the current generation of smart money concept traders don't really understand what a real fair value gap is. For now, I'll just give you a small idea. I'll just tell you that when there's a trending move or a continuation or any move which has 3 similar drives, okay, drives of price, meaning it's moving in one single direction, and then the middle candle, the high for a bullish fair value gap, for a bullish fair value gap, the previous candle's high, the first candle's high, and the third candle's low, right? They don't mingle or interfere with each other. They leave a small gap of price. This is called a fair value gap. This is a fairly basic idea of a fair value gap. It's more complicated in this. There's levels to this. There's levels to this fair value gap. I'm not covering it here in this small video because it'll become a very lengthy video otherwise. I'll try to save it for another video. I'll make a small different video to explain fair value gaps, change of characters, and all that. Right now, let's focus on the method we are following. Now, in your chart, Very simple. What do you see? You see some levels here. Before that, let me just double click on these levels. You see this is a Forex plus CFD. This is the breakfast indicator for that. And it's all the same. Everything is same. There's no special changes. Every indicator will look the same for your US future comics, right? So the first thing you can notice here is that I have turned off the pressure signals. I have turned it off, and GAN levels I've turned it off, because we're discussing your fair value gaps first. Fair value gaps plus price macro. So here you have your price macro, you have your fair value gaps. You can modify the colors, you can modify the length, width of the price macros. It's all up to you. It's customizable, but frankly speaking, it does not really matter. That is not our, how they look is not really our expertise here. We are looking for the concept of philosophy of how to find the edge in the market. How do we apply it? Now, these fair value gaps and your price macros, they will get triggered in the time zone. Okay, within the time zone, they will get triggered. After the time zone and before the time zone, it will not be available. Simple. What you need to do right now? Simple. The first method, in the time zone, especially in the time zone, what you're going to find out is fair value gaps. This is a this is a bearish fair value gap. You can see this. This is a bearish fair value gap here. It's indicated in red. So what are we looking for? We are looking for fair value gaps to be retested. These fair value gaps are valid only if they trigger from the price macros, right? So many of you have tried fair value gaps, but exactly in a specific price area, when this fair value gap forms, that is a valid fair value gap. So how do you verify which is an important fair value gap? You have to check if it is some part of the body of the candle, not wick of the candle, some part of the body of the candle where the fair value gap has been generated. It has to be touching your price macros. Okay, these are price macros. This is the top zone, middle zone, and bottom zone. Simple. So in this example, it's very clear that the first candle itself, when the time zone starts, you can see a bearish fair value gap. It's some part of it is in the price macro, right? So this is a valid fair value gap. So what do we want? We want price to come and retest this fair value gap. This gives us a signal, right? This gives us a setup for us to follow. Simple as that. Now you see there's another fair value gap in this drop here. In this drop, there's a fair value gap again, right? Here you see this fair value gap formed, bearish one. Half the body or some part of the body is touching the price macro, right? So this is a valid fair value gap. But what about this green color candle here? This also has given us a fair value gap, but none of the body is in the price macro. I hope that is very clear. It is very important for us to understand this concept, price macros. It took me years to figure this out. It took me years to figure out that price also, your fair value gaps, your liquidity sweeps are triggered by algos, right? And where do they happen? That is the secret sauce. That secret sauce is nothing but your price macros. All right. Now, this is a very, very simple method. Very, very simple method. Where are you going to find it hard? What's the difficulty? What's the catch here? The catch is the first bit I told you. You have to identify the structure before the time zone. Correct? You have to identify the structure before the time zone, what is happening in the market, and then you have to use your edge, right? So what is the core philosophy? The first part, if the trend has to continue, there has to be a correction, right? If you want a trending move in this time zone, if you want to see a trending move trigger in this time zone, you have to see if there's a correction going on before the time zone or it is going on within the time zone, somewhere here, right? So you want a correction to start or finish near the time zone, so that after the time zone you find a trigger which gives you a trending move. That is for trend continuation. Now for trend reversal, suppose in this case is a trend reversal. This is a terminal leg, terminal wave. Now I'll go into details of terminal waves in the Elliott wave master course. I've done that. I've told you all the waves which are the end wave. Suppose this is an A, B, C wave. If this is an A, B, C, it's very simple. What is your terminal wave? Your C wave is the terminal wave. Now, if you ask me, so how do I find the specific point? So within this C wave, there'll be a 1, 2, 3, 4, 5 pattern. If you can't see, sometimes you won't be able to see this 1, 2. You'll directly go like a straight line like this, right? And then market falls down like this. Because of the fast movement in price, you will not be able to see wave 1 and wave 2. What is this pattern? This is nothing but so-called turtle soup, your carrot soup, your whatever soup you want to call it. This is nothing but your turtle soup pattern. It's nothing complicated, right? It's as simple as that. Trend reversal pattern. Okay. So what do you need to do? You have to study the Elliott Wave Master Course. There is no other way. What is the philosophy again? We are using Elliott Wave Master Course to figure out the next probable path. We're trying to identify the setup. And then we are using your smart money or ICT concepts to find the entry points. This is the edge. Now, what are the valid entry points? Your price macro helps. So for entry, we're trying to find fair value gaps. Price macros will tell us this is the correct fair value gap to follow, because you will see so many fair value gaps forming whenever you practice more and do your own research. You will see so many fair value gaps. Which is the correct one? Which one should I follow? This is your filter for that, price macros. The price macros are very, very powerful. As you go further into the video, you'll understand that. So this is the first method. Now there's something called your breakaway gap. In fair value gaps, there's something called breakaway gap, right? There are fair value gaps which do not get retested. These are called breakaway gaps. These breakaway gaps form in two areas. Like I told you, first philosophy which we are following was a trend continuation pattern, right? So you see price goes sideways here and then it blasts, correct? So this is some form of a, if you have studied the Elliott Wave Master Course again, some sort of a wave 3 pattern. These patterns usually trigger a fast move in the market and they don't come. Here you see that there was a small fair value gap. It got retested. Here again, there was a small one. Here again, there's a small one. So when you see there's a huge fast bullet type move here, in this case, you don't have to wait for this price macro be tested. You can use the retest of other fair value gaps also, right? So this is your valid fair value gap because some part of the body is there in the price macro zone, correct? Here, if you see this one, it is not touching the price macro zone. It's not a valid, but this is a breakaway gap. This is a breakaway gap because we saw consolidation in price before, and then it triggered a fast move. Just triggered like that. This is one of the areas where you will see enduring trend continuation, that breakaway gaps form. All right. Now, why is this silver bullet? I will talk about this later in the video, but right now that's not our focus. Let's complete your first method. Simple. Now, breakaway gaps you've seen here. Let's see another breakaway gap. This breakaway gap is a trend reversal breakaway gap. The previous example, what did you see? It was a simple breakaway gap of your trend continuation. Here, what do you see? That there is a wave which completes here. This is your wave 3, your wave 4, and 5th. What does it look like? Basically, what does this look like? Same turtle soup pattern, carrot soup, whichever soup you want to call it, right? It's the absolute same thing, right? So what do you do here? Now, very simple. Question is, once you understand that this is not the end of the move, right? And there's another leg higher coming. What is happening here? What kind of wave is that? When you understand that this is a terminal leg, this is the final wave, and then market is going to turn around. What are you looking for? You're looking for a price fall here. Now, question here is breakaway gap. You see there are multiple fair value gaps here. There's a bearish fair value gap formed here. Very good. But it did not get retested. It did not get retested here, right? It did not retest here. So what do I do? Why is it breakaway? The reason for this breakaway is that if the terminal leg is a fast pump in the market, the equal and opposite force reaction starts. This generates breakaway gaps. This generates breakaway gaps. You can see there is breakaway gap here also, right? So this fast move, if the terminal wave is fast, it's in a pump state, pump or a dump, whatever you want to call it. The equal and opposite force, if it's triggered, and we see this kind of gaps here, breakaway gaps. So in that case, what do? We refer to other fair value gaps, right? We refer to other fair value gaps. We refer to other fair value gaps, right? To retest, as simple as that. But there are situations where you're not comfortable with breakaway gaps, you leave it. Leave that day, it's over. There's no setup, you move on to the next day. As simple as that. This is breakaway gaps. Now we'll move on to the second part. In the second part, I'll show you how to integrate your price macros with pressure signals. Pressure signals are fairly easy. I think, like I said earlier, many of you are already familiar with it. Go to your settings. Go to your settings here. Pressure signals, turn them on, right? Turn on your GAN levels also. You can change the line color here. You can change it to black. You can change it to any other. You can change it to dotted line. You can change it to, like, it's up to you. Customization is there option. So do that. It's as per your wish, but these are not important. Customization is not really that important. I'll tell you what you must focus on first. Now, pressure signals is a combination of price, time, and volume. That's when it gets triggered. Now, this long signal has been triggered here, right? In the time zone. First important point. It's very simple. Try to listen to it very carefully. Identify the previous structure. Identify a previous structure. So retail people, you can call this your pole and flag pattern. You can call that. Your smart money concept peoples will call this internal liquidity sweep, right? Your wave analysts will call this your A wave, your wave, three wave leg pattern here, your B wave, and then you expect a C wave to happen, right? So the same structure, there are multiple, you know, names for it, but does not matter. The important point is that you identify this first. So what did I tell you? Before a trending move, in that trending move, if there is a correction, what will happen? Trend continuation happens. So this is a trending move. If you want a trending move here before the time zone, and like if it comes and finishes, a retracement or a correction happens, and then you can expect a trending move to start. So you have to identify this wave first, right? And then when you have this signal, long signal, this is not a signal for taking trades. Try to understand that. It's very important. This is not a signal for taking trades. This is not a long signal entry. This is a buildup of long side pressure. Try to understand. That is very important. This is a combination of price, time, and volume. That's why it gives you a signal for pressure. Long pressure has been built here. All right. So as soon as this gets triggered, you wait for the candle to close. You wait for the candle to close, and then you will get these pressure signals. It will get triggered, right? These GAN levels you see here will get triggered. So the GAN levels can help you to identify your strategy. It can be, you can decide whether market has to sustain above this level, or this is your stop loss, or this is in case where market reverses, whatever. You build that strategy on your own. I'm telling you what these GAN levels are. So let's play this forward. I'll show you an example here. You have different GAN levels. Right now, what you want to see is whether some level, or suppose this is your target, right? This is a usual target, which in my research I've seen. This is the first, double zone here, double level. This zone usually gets retested if this move is sustainable. So what I usually do is I watch this level here. If market sustains above this, it's very good, right? So I can hold on. This is what I expect from the market, and this is what I see. So you see here, market goes all the way till there. So this is a basic target which you can apply. Again, I'm not teaching you how to trade here. I'm just showing you my research tool. Here, this is what I focus on. All right. Now, a valid pressure signal. What is a valid pressure signal? So like I told you, we use one of my most powerful and potent research tools, your price macros. This pressure signal if it's triggered from a price macro level. This is very powerful, right? When you go into your research part, you'll see there are multiple signals, right? There'll be multiple signals based on what chart you follow. If there's a news event, there'll be multiple pressure signals. But once it's triggered from your price macro level, this is very powerful. This is a valid or a strong pressure signal. This is what I wait for, right? This is one of the methods. So pressure signals are very simple, very easy. The secret sauce here again is identifying the structure and your price macros. All right. If you see the example here, very simple. You can see multiple pressure signals, right? Short, long, short, long. These are build up areas. Pressure has been built up like that here. Why should you avoid this? First question. Why should you avoid this kind of scenario? Because your move was a trending move here. It was not a terminal leg or it was not a consolidation. First philosophy, which I told you, for trend continuation, you have to see a sideways move here or some correction, sideways or correction, retracement, or you have to see a terminal leg. If your terminal leg happens here, if the terminal leg finishes here, then this part will trigger a reversal here, right? So we want a trending move to catch. We don't want a sideways pattern. So if the trending move is already over, then in your time zone, you will see a sideways pattern, and then your these kind of signals will generate, and this is what you will get trapped in. So like I said again, the secret sauce is identifying the setup first, and then we apply our edge over it. In the edge, we have your price macros, right? So this is one of the scenarios where you will face difficulty. I'm trying to explain it ahead because you don't get surprised when you see this. This is because it's very easy to identify this. You just have to figure out whether market is going for a sideways pattern here or it is going to trigger a trending move. That's all. That's all. That is all you have to. If it's a sideways pattern, you skip that day, you go to the next day, right? Now, another example where I'll show you. This example shows COMEX gold futures on the left, your MCX gold futures, and your gold, right? Commodity CFD, right? On the right side. In the middle, you see that there's some cluster of fair value gaps that are not neat. They are not neat here at all. On the right side, your gold CFD, XAUUSD is very clear. Exact same pattern is in the COMEX gold futures on the left. So all this is very good. This one is good. This one is good. Why should we avoid this? Here, if you see, you have to avoid fair value gaps in this gold futures MCX because you see the gaps here. Every single candle has gap, right? Every single candle, almost, it's almost as if this is an illiquid instrument, correct? So all this is different. So if you are looking at MCX gold futures, if you want to scalp here, I would highly recommend. And if you want to use fair value gaps, if you want to use the first method, the fair value gap method, try to track and sister pair, sister instrument like COMEX gold futures, or you track this. So if you see this, this is the exact same chart. This is the exact same chart. Why are the values different? Why is it around 3,200 here? Why is it around 3,194 here? Participation differs. Your participants are different. Your supply demand might be different, whatever. But you see that they're the exact same charts, exact same. The triggers, the fair value gaps, everything is same, right? So it's quite similar for MCX also. But again, fair value gaps, I would highly recommend to avoid here, turn it off because there are gaps everywhere, right? So it will mislead you. Use pressure signals enough. Here, if you see any chart which you're tracking with these kind of gaps, we don't want to work here. If using fair value gaps, again, you can work using pressure signals, but without fair value gaps, it's much easier if you use pressure signals here. Okay. These kind of liquid instruments, these are highly efficient instruments. You can see the values, how the price moves, right? It's exactly clean, very good and clean here. This is what you want to focus more on. All right. Now the third method, the silver bullet method. Silver bullet is a combination of the first two. Very simple. This happens in my opinion, in my research, it happens 5 to 10 times a month. Rare. It's very rare. 5 to 10 times a month is approximately like once or twice a week. Once or twice a week, right? What is this? Very simple. Your price macro from where your long pressure has been built up. Also, with that, there's a fair value gap. So it's a combination of first method and second method, right? This triggers a beautiful, beautiful move. I don't really know how to describe it, but this is it. This is the silver bullet, the combination of both first and second methods. If you see this and you miss it, then I can't really help it. Silver bullet, again, another example here. It's a very, very clean example. If you see this, the first, like I said, the price macro is a very important tool for us. It triggers what? Your fair value gap. From here, if you see a fair value gap, also you see a bullish signal here, long build up, right? Here, what has happened? A previous trend has finished or terminated. This is the last leg in your exact price macro. And then immediately when it reversed, we see a long pressure build up, right? This long is not in this candle. It's actually for this candle. The long as sometimes shifts to the next candle. But anyway, regardless, the idea here is that there's a long pressure build up. All right. There's a fair value gap also. So if you recall, what did I tell you? A long pressure buildup. There's a fair value gap here also. You can see how price is held here. Price is held here, right? It does not go, it does not close below it. It retests this fair value gap, sure, because this is a valid fair value gap. Here, combining both, what do you see? A fast move here. If you miss this here, you see this point here again. A fair value gap within the price zone. A fair value gap within the price macro zone. Price comes, dips into it here, goes back higher, right? This is the silver bullets setup. So these fair value gaps, we want them to be formed within the time zone. We want price macros will get triggered within the time zone. This is a very, very potent and very powerful method, which I've shown you all these three methods. Very simple. I don't really know how to describe the silver bullet, and I sometimes get surprised or astounded by seeing the price movement when these things happen. These are worth a lot, guys. And many years of my research have gone to figuring out a simple yet sophisticated method to track markets and scalp. I don't want so much, so I don't want to take so many trades. I want precise, high caliber bullet, silver bullet setups so that I can easily navigate through the markets. I don't want to I don't want the headache of carrying my trades across the day. Just do my work, scalp, and get out, right? So let me remind you again, the breakfast time is from 9:45 a.m. to 10:15 Eastern Standard Time. So how do you access the breakfast indicator? Now the breakfast indicator, let me show you the packs again. First pack is your futures, US futures. The second pack is your commodities, the entire COMEX futures, your MCX futures, also with your US oil and UK oil. The last third pack is your Forex plus your CFDs, your Forex plus your metal CFDs like XAU, USD, your silver, right? And then your cryptos as well. The cryptos, you have your spot cryptos, your index cryptos, swaps, right? All that comes under that category. So these three are available. Each of them are different indicators, right? There are a total of 7 indicators in the entire 3 packs combined. Here, very important for you to understand is that this is available for a trial version. You can apply for the trial version. The link for the Google form of the trial version is in the description box. The trial version, you'll get it for 14 days of the full version. Trial of the full version. All right. There's no demo version like we had in the Indian markets. This is the full version I'm giving you for trial. So what you need to do is you need to fill up the trial version Google form. Let me know in that your trading view username, right? Or your profile name, whatever is there. Let me know that so that I can give you access for 14 days of free trial. Simple. Now, after 14 days, there's a full version. It is a monthly subscription, and this will be released from the 28th of May, 2025, right? If you're watching this video on a later date, it must be already released for you. So keep that in mind. Trial period for 2 weeks, and then you can apply for the full version. So in that trial period, figure out your strategy, see if it works for you, look for silver bullet setups. So kindly note that your Indian market breakfast indicator is in a separate video. Pricing, all that for this commodities breakfast indicator is available in the Google form for the full version. For the trial period is completely free. All right. So your monthly subscription details, your discount dates, all that is available in the Google form. All right, guys, I hope you have learned something new in this video. I'll see you in the next video. Until then, take care and be safe.